Alright, another concept that is useful in the budgeting calculation would be the gross profit markup. We've seen the gross profit markup earlier as well in the course. What is the gross profit markup? That's just a percentage of profit that we express on the cost of sales or on the cost of goods acquired. This is basically how firms use to price their goods, where the profit is expressed after the cost of goods have been determined. Now, similarly, while preparing budgets, if you have your sales forecasted, for example, if I have my sales forecasted to be 150,000 and we know the firm's markup policy, which is let's say 50% in this case. Now we can use this information to also determine our purchases, assuming there is no inventory. Now, how would we use this information to calculate your purchases? So yeah, let's write down this equation. We know that we write this down as sales minus cost is equal to profit. That's the basic equation we all should use, not use any formula or anything else. So we can write 150,000 to be sales. Cost is not available. The cost of these goods are missing. We can write that to be X. And your profit can be 50% of this X. Remember, markup is the percentage of profit expressed on the cost of sales. So 50% markup means that whatever the cost is, be it 100, 200, 50% of that will be your profit. So your profit over here becomes 50% of X. So I can rearrange this equation and I can say 150,000 is X plus 0.5X. That gives me 1.5X to be 150,000. And we can now find the cost to be 100,000 over here. So if I break this up, 150,000 is 100,000 should be the cost. 50% of that is your profit. That becomes 50,000. Now, which figure are we looking for? It's the one over here, which is the cost, that is 100,000. So if we have our sales available, we can find the purchases too by tracing out the cost using the markup. Alright, so you might come across some questions where they do not give you purchases, but would rather give you the markup, and using that markup, we need to calculate our purchases. Now let me apply this to an example. Okay, you guys can see they're saying Clear Traders has prepared the sales forecast for 5 months. We have a sales forecast running from June till October. The sales in June is 280,000, 250,000 for July, 270 in August, 280 in September, and 290,000 for the month of October. Okay, now the information that is given over here is that all sales provide 60% gross profit on cost. That's how we have to use this sales. 60% is your markup. Now using this markup over here, we need to trace out our purchases as well. After that, they're expressing the terms over here. Half the sales is paid in the same month. You get a 2.5% cash discount. The rest are paid in the next month. Now these are our sales terms. We've already learned how to deal with them. What I will focus is on purchases over here. After that, they're saying it is the company's policy to arrange purchases at the end of each month to exactly cover the forecast sales for the following month. Now this line has an important implication. They are saying that all the sales will be arranged a month before. So for example, this month of June, where you have to sell 280,000, but you will buy this 1 month before. You will buy this in May. This one you'll buy in June. This one you'll buy in the month of July. They're saying we have to arrange purchases so that at the end of each month, the stock that you hold is for the following month's sales. So the first thing that we need to do is we need to understand that these goods must be bought 1 month before. So let me write down the dates first. So yeah, we can now say that this was purchased in the month of May, this was purchased in the month of June, July, August and September. So just take this 1 month back to first find purchases. Once you know the timing, you can also determine the cash flow after that. So now the next step is to find the cost. Now we can use this markup. We know 60% is our markup. So we'll take these sales and we'll trace out the cost of these goods. That will be your purchases, and that's the month of purchase. So let's do this exercise first. Alright, so we'll solve this over here. I've written this down. Sales minus cost is equal to profit. That's our basic equation. Now for every sale that we have, we need to find its cost. So let's do that over here. So for the first one, which is the sales in June but will be bought in the month of May, 280,000 was your sale. I've done the same thing. 280,000 minus X is equal to 60% of X, which is your markup. So 280,000 becomes 1.6x. Now use this equation for all your sales, because you know that all sales will end up to be 1.6x. So over here I get my purchases to be 175,000. These goods were acquired for 175,000, but one thing to take a note, they were acquired 1 month earlier, which means that they were acquired in the month of May. Alright, let's do the same thing for the other ones as well. So the sales in July is 250,000. I'll just do 250,000 as 1.6x. I get my purchases to be 156,250. That's my purchases, but remember again, this purchases was bought in the month of June. Next one, sale in August is 270,000. If you guys solve it similarly, you'll get your purchases to be 168,750, but this one was purchased in the month of July. After that, the sales for September was 280,000. You guys can calculate that to be 175,000. But this is the sale in the month of September, so it must have been acquired in August. And finally, the October sale was 290,000. We'll divide that by 1.6 as well, and we'll arrive at 181,250. You guys should double check our calculations, but this one was purchased in the month of September. Alright, so whenever you have a case where they've given you sales with the markup, we can use that markup to trace our purchases down. After which, we can use these purchases to find out the cash outflow required for the cash budget.